1st July 2022 marked the completion of 5 years since the goods and service tax was introduced in India. What has GST implementation achieved? Has it delivered on its promises? Has it been able to ensure GDP growth or curb inflation? What is the process by which GST rate rationalization is carried out? What are the problem areas and what is the current furore with respect to the GST? To know all this and more, let us deep dive into the issue of GST and have a comprehensive look at it from a current affairs examination perspective. GST was initiated as a one nation, one tax policy on 1st of July 2017. It has brought 13 lakh taxpayers into a unified indirect taxation system. The profound idea behind the implementation of GST was that it would offer a win-win situation for all stakeholders, be it the governments at the center or states, taxpayers or the tax administrators. The introduction of GST has simplified business processes, tax administration and compliances in India. The Ease of Doing Business Index, a measure used by the World Bank Group in which paying taxes is one of the most important parameters used to determine a country's ranking, has shown a significant change. India's ranking during 3 years, that is from 2017 to 2020, showed a jump of 37 places from being rated 100 to jumping up to 63. The GST also represents an unprecedented exercise in fiscal federalism as the center and states come together in the GST Council to thrash out modalities for smooth functioning of the relatively new tax regime. It was said that the gross domestic product would rise by 1 to 2%, inflation would decline with the elimination of the cascading effect, and the black economy would be checked. It was supposed to benefit backward states, which are consuming states, since GST is a last point tax collected where the final sale occurs. Let us have a look at the background behind implementation of GST. GST was first discussed in the report of the Kelkar Task Force on indirect taxes in 2003 and was long in the making. The quasi-federal nature of the Indian polity, wherein both the center and the states enjoyed independent powers of taxation, demanded a unique solution. States of different sizes and at different stages of development with their legacy tax systems had to be brought together under the GST. States were also at different stages in the use of technology for revenue collection. Under the political will of the Government of India, it was easy for the GST Council to take important decisions relating to the framework of GST prior to implementation on 1st of July 2017. Moreover, the state commercial tax officers and Central Board of Excise and Customs officials used to meet on a day before the GST Council meeting to resolve all differences amicably. Let us have a look at the evolution of the GST. Producing states were resistant to a last point tax since they feared losing out on revenue to the consuming states. The more advanced states produce proportionately more than the less advanced states and sell more to the latter. Thus, the less developed states were expected to collect proportionately more GST, though less in absolute terms. Hence, advanced states like Gujarat and Tamil Nadu resisted the implementation of GST. States also opposed GST because it proposed one common tax rate on a good or service all over the country. This loss of power to fix the rates of tax on various items undermines fiscal federalism. The needs of one state are different from those of another, which is why a certain degree of autonomy is crucial. Further, states feared loss of revenue due to the shift from the then prevailing tax regime to GST. Under the GST regime, 17 of the then existing indirect taxes were merged into one. To collect the same amount of revenue as earlier, the GST rate had to be suitably fixed. This was referred to as a revenue neutral rate. If not correctly fixed, revenue collection could fall and aggravate fiscal problems, as recent reports suggest. The states agreed to come on board when their concerns were addressed. Firstly, they got some autonomy to collect revenue from their cash cows, which is alcohol and petroleum products. They were kept out of the purview of GST. States could levy excise duty on the former and value-added tax on the latter. This helped during the pandemic when tax collections declined sharply. But this provision implies that cascading effect is only partially eliminated. GST was expected to eliminate the cascading effect, which raises the effective tax rate on goods and services and thereby helps moderate inflation. Secondly, the union government was to compensate states for 5 years for any shortfall in revenue growth below 14%. For this purpose, a compensation cess was proposed on luxuries and sin goods. This mechanism also ensures that the producing states would not lose out on revenue. Thirdly, a GST Council with representation of each state and the union government was to decide on GST related matters. Voting is provided for in case of lack of consensus. The union government has 1/3 of the votes and the states together 2/3. Since 75% of the votes are required to pass a resolution, the union government effectively has veto power. Further, it can arm twist the smaller states to vote in its favor, and currently the ruling party in the union can push its agenda since it also rules in many of the states. So, while technically federalism is maintained, in reality it is diluted. The recent Supreme Court ruling that the GST Council's diktats are not binding may strengthen federalism. Let us have a look at the GST Council. The GST Council is a joint forum of the centre and the states that was set up by the President as per the amended Constitution. The members of the Council include the Union Finance Minister, who is also the chairperson, the Union Minister of State for Finance from the centre. Along with this, each state can nominate a minister in charge of finance or taxation or any other minister as a member. The Council, according to Article 279, is meant to make recommendations to the Union and the states on important issues related to GST, like the goods and services that may be subjected or exempted from GST, model GST laws, etc. It also decides on various rate slabs of GST. For instance, an interim report by a panel of ministers has suggested imposing 28% GST on casinos, online gaming and horse racing. The GST Council has played a crucial role in forging a national consensus on key issues related to the tax regime, such as rates, exemptions, business processes and movement of income tax rebates, etc. So far, the Council has met 47 times and has taken measures which has made Rs 1 lakh crore GST collection per month a new normal. What are the highlights of the 47th GST Council meeting? The 47th GST Council meeting was held in Chandigarh in June 2022. More clarification will be given for allowing money in electronic credit ledger and electronic cash ledger to be used to pay output tax dues in returns. Such amounts cannot be used to pay off penalties, late fee and interest. A comprehensive review of the National Anti-Profiteering Authority was also proposed. The government may soon appeal in Supreme Court against cases where the National Anti-Profiting Authority has been remanded by the state high courts against the orders. The National Anti-Profiteering Authority has set up an advocates panel to ensure justice to consumers where profiteering has occurred. The GST Council approved the waiver from the filing of refund claims by condoning the 2-year COVID period between March 2020 to Feb 2022. The Council decided to permit tax authorities to file appeals against erroneous refunds by not considering the 2-year period. The GST Council also decided to make it easy for refund claims for export of electricity and select concessional goods with an inverted tax structure. The GST network may set up artificial intelligence or machine learning based systems to cross-check the antecedents of the GST registration applicants and improve risk-based monitoring of their behavior post-registration so that the non-compliant taxpayers can be identified at a nascent stage and actions be taken so as to minimize revenue losses. A decision was taken to defer the implementation of the GST margin scheme for tour operators after studying it in detail. The GST Council decided to form a group of ministers to consider setting up a GST Appellates Tribunal after a detailed study of its structure. Let us have a look at the overall GST picture. Prior to GST, there were more than 20 slabs of taxes imposed by various state governments on various commodities. However, under the new GST regime, it was decided to have 4 different rates for different categories of goods and services in addition to the exempt category of goods and services. The basic principle behind deciding the 4 slab structure was that no commodity should bear more tax than it used to have prior to GST. Currently, the 4 rate structure exempts or imposes a low tax rate of 5% on essential items and a top rate of 28% on cars is levied. The other tax slabs are taxes of 12 and 18%. Besides, there is a special 3% rate for gold, jewellery and precious stones and 1.5% on cut and polished diamonds. During the pre-GST era, the total of VAT, excise, CST and their cascading effect led to 31% as tax payable on an average for a consumer. Efficiency in logistics chain. The central sales tax regime included an intrusive control system involving border checkposts and physical verification of goods-laden trucks, which resulted in loss of time and fuel. As a result, the logistic chain for the movement of cargo even within the country could not acquire scale and efficiency. Logistic costs were estimated to contribute as much as 15% to the cost of goods. With no such conditions under the IGST and with the e-way bills, the logistic supply chain efficiencies have increased manifold. In the pre-GST regime on most items, the combined center and states rates were more than 31%. However, under the GST, the rates of over 400 goods and 80 services have been reduced. Sin goods. The highest 28% rate is restricted to sin and luxury items. Out of a total of 213 items which were in the 28% slab, close to 200 have been shifted to lower slabs. Luxury cars, which fall in the highest bracket, are charged with a further sin tax that puts half the purchase price of a sports utility vehicle in the government's pocket. Car makers have complained bitterly about being clubbed with cigarettes, but the sin taxes helps New Delhi run a compensation fund which effectively guarantees states an annual 14% revenue growth for the first 5 years under GST. This was a deal clincher as it persuaded states to forego most of their own taxes. Those 5 years have just ended. However, because of the pandemic, the fund state declined in its final 2 years, forcing the centre to borrow from states to keep its pledge. Hence, cars might still be super expensive until the debt has been repaid by March 2026. Special attention to MSMEs. The enhancement of the threshold exemption limit from Rs 20 lakh to Rs 40 lakh for goods and services and the induction of the quarterly returns and monthly payment scheme has the potential to benefit 89% of the taxpayers. Such suppliers who make only intrastate supplies need not seek GST registration if their annual turnover is less than 40 lakhs in the case of goods and Rs 20 lakhs in case of supplies. Technology upgradation. The GST network, being IT based and fully automated, has a constant review mechanism with upgradation of hardware and software capacities. To help tax officers in administration, the GST network, which provides the technological backbone for the indirect tax regime, has been using artificial intelligence and machine learning to dish out newer data and plug revenue leakages. Refunds. The system of automated IGST refunds by customs and refund of accumulated input tax credit to exporters by the GST authorities has made the neutralization of input taxes on export goods and services seamless and hassle-free. Let us have a look at the performance of the GST till now. Over 63.9 lakh taxpayers migrated into the GST in July 2017. This number has more than doubled to over 1.38 crore taxpayers as on June 2022. Over 41.53 lakh taxpayers and 67,000 transporters are enrolled on the e-way portal, generating an average 7.81 crore e-way bills per month. Since the launch of the system, a total of 292 crore e-way bills have been generated, of which 42% are for the interstate transport of goods. 31st May 2022 saw the highest single day generation of 31,56,013 e-way bills. The collection from GST has been on expected lines. The average total GST revenues crossed rupees 1 lakh crore mark consistently starting October 2020. The average monthly collections have increased from 1.04 lakh crores in 2020-21 to rupees 1.24 lakh crores in 21-22. In the first 2 months of this year 2022, the average collections were rupees 1.55 lakh crores per month. The GST revenue collection for April 2022 was highest ever at rupees 1.68 lakh crores. It is a reasonable and fair expectation that this steady increasing trend will continue. The GST return filing, which plateaued around 71 to 72% earlier, has now increased to 85 to 90%. Auto population of the data has also improved data quality in statutory returns, facilitating efficient intervention by tax officers for scrutiny or audit. However, there are several reforms which are required. Let us have a look at the criticism which the GST has faced. The GDP growth rate, instead of rising, has fallen quarter on quarter. The entire decline cannot be attributed to the GST, but it has contributed substantially to it by damaging the unorganized non-agriculture sector, which is 31% of the GDP. This sector was first hit by demonetization, which was implemented 8 months before GST was introduced. GST exempted the unorganized sector yet damaged it. The unorganized sector neither gets nor can it offer input credit. Its cost and sale price both increase compared to the organized sector. Consequently, the demand has shifted from the unorganized sector to the organized sector. Resultantly, inequalities have increased and the demand has declined, leading to the economic slowdown. 95% of GST is collected from the organized sector. As this sector grew at the expense of the unorganized sector, GST collections increased. This is corroborated by the big increase in direct tax collections, which are collected from the well-off and the organized sector. The rapid increase in GST collections when the economy is stagnant points to the problem faced. Anyhow, an increase in indirect tax collections is bound to be inflationary. Fixing a revenue neutral rate of tax, that is, one standard slab for each item at approximately 15.5%, also implies that inflation would not be moderated. If part of the increase in GST collection is attributed to better compliance, it points to the extent of tax evasion in the organized sector. GST has not been able to check the growth of black money due to multiplicity of rates and complexity of rules. While a category of goods or services has one tax rate nationally, across goods and services there are many tax rates, at least amounting to 8. This goes counter to the requirement of GST that there be one tax rate. But in an economy like India, that is not feasible given the poverty and diversity of production structures. Innumerable changes in rules have been announced and the courts have been flooded with cases. Fake companies to claim income tax credit have been detected. E-way bills have seen manipulations and corruption. Due to the complexities and the lack of clarity in official pronouncements, businesses have often complained of difficulties. A company that operates nationally has to file forms monthly for each state of operation, thus adding up to hundreds of forms. The functioning of GST network has also caused problems from time to time due to large volume of data which is required to be uploaded. Thus, the cost of compliance is high especially for the unorganized sector, since computerization is essential to be a part of GST. Effectively, the unorganized sector faces a challenge whether it is kept out of GST or brought under it. Since the less developed states have a proportionately larger unorganized sector than the better off states, they have suffered more due to the decline of the unorganized sector. Thus, interstate disparities have aggravated even though consuming states are supposed to benefit. Prevent tax evasion. With the help of rich data available with banks, depositories, various tax authorities, tax evasion could be easily prevented. This is evident from the annual statement of information produced by the Income Tax Department for better tax compliance. Prevent frauds. The foolproof return system should prevent any possibility of input tax credit frauds being perpetrated by some elements. Rationalized duty structure. The GST structure should be further rationalized by reducing the number of slabs from 4 to 3 initially. Tax exempt goods. Imposition of moderate tax on some exempt goods and services may also be a step in the right direction. With emerging technology, there is an emergence of a newer class of assets like virtual digital assets or cryptocurrency. There is a need for clarity on whether they would be classified as supply of goods or services and what would be the tax rate on them. The decision makers in the council have to work out a solution as state governments stare at a stoppage of compensation for revenue loss due to GST implementation. When GST was rolled out on 1st July 2017, states were promised a compensation from the cess fund for 5 years if their GST collection falls short of the 14% compounded revenue growth. Most states have sought an extension to the compensation mechanism, and a final decision is likely to be taken at the next GST Council meeting in Madurai in the first week of August. The end of compensation, however, doesn't mean fiscal sufficiency. During the past 5 financial years, only one large Indian state, Odisha, recorded more than 14% annual growth in its GST collection. 4 other states chalked up growth rates of between 10 to 14%. While 16 others saw single-digit expansion. Uttarakhand, which relies on tourism in its hill resorts, witnessed a decline. It is for this reason that compensation has become an important source of revenue for states. Without it, the GST revenue growth of most states will not reach 14%. Completed real estate is a cesspool of tax evasion and it has been left out. An end-to-end tracking of the money involved, right from the landowner to the sand supplier to the interior decorator, is necessary to plug rampant tax leakage. At present, GST collections are shared equally between New Delhi and the states, but the states want the split to be tweaked in their favor if there is to be further no compensation from sin taxes, which until recently were set aside entirely for them. The discontent runs deeper than a bickering over a formula. A consumption tax is regressive. It hurts the poor more than the rich. Over-reliance on GST has reached the point that even the fee that banks charge for a new checkbook will now be taxed at 18%. Meanwhile, direct taxes on corporate profit have been slashed by the government. The real challenge posed by GST arises from the adverse impact on the very large unorganized sector. The second challenge is the presence of a large black economy in the organized sector and the resultant low direct tax to GDP ratio, forcing the government to try to collect more and more from indirect taxes like GST. Liquefied natural gas and aviation turbine fuel have to be brought into the purview of GST as early as possible. Having uniform rates on ATF along with the facility for input tax credit will help the aviation industry in a big way. LNG, despite being a feedstock for many items of production, is not a part of GST and thus input tax credit on LNG is not available, which creates cascading of taxation for many commodities. With petrol, diesel and ATF outside GST, a large part of the economy is still not covered by the indirect tax regime. Inclusion of petroleum products under the GST net could reduce the cost for companies. The direction for reform is clear. GST is the last point tax collected at the point of final sale. So why not levy it on the MRP of the final product and collect it at the last point rather than at each stage of production and distribution? This would bring about simplicity, eliminate problems due to input credit, e-way bills, reverse charge, filing of hundreds of forms, inverted duty structure, etc. The disadvantage the unorganized sector faces and demand shifting away from it would be eliminated, leading to a higher growth and employment. The proponents of the present GST argue that black income generation would increase if income tax credit is eliminated at each stage. To the contrary, a simplified structure would reduce Inspector Raj, enable easier detection of fraud, and therefore reduction in black income generation. Since 95% of the GST is collected from 5% of the units, that would be much easier to monitor and check black income generation. The Indian economy is unlike other large economies and it has its own issues which the present partial form of GST is aggravating rather than resolving. Let us have a look at the current crisis with respect to the GST. The GST Council in its 47th meeting recommended a levy at the rate of 5% on certain essential items such as pulses, rice, cereals, etc. when supplied as pre-packaged and labeled items. These changes are effective from 18 July 2022. Earlier, these items were taxable only if supplied under a brand name and packed in a unit container. Now, the distinction between branded and unbranded items has been done away with to bring all pre-packed and labeled items within the GST net, even if such items are unbranded and without any unit container. The levy of GST on essential items such as pulses, cereals, and rice has led to an uproar that it will lead to a rise in prices and impact the common man. This viewpoint gains importance, particularly under the current economic situation of high inflation in fuel and daily consumables that have affected the household budget. In this context, it is important that the following points merit attention. Firstly, these changes are applicable only to goods which are covered under the Legal Metrology Act, where most of these items in question are already being sold under the brand name on payment of GST. Thus, it is unlikely to result in any significant gain in revenue collections, unlike the recent windfall tax on fuel. On the contrary, the Honorable Union Finance Minister clarified that there were concerns regarding revenue leakage as certain businesses were misusing the exemption provision for unlabeled food items by not registering them. This is what has led to the decision to withdraw the exemption and bring the pre-packaged and labeled food items under the GST net. She further clarified that only the modalities of imposition of GST on these goods have changed, with no change in coverage of GST except for 2 to 3 items. Secondly, any changes in the GST can only be implemented with consensus between the centre and the states based on the clearly laid out process in the form of recommendations of the GST Council. Therefore, it's not a unilateral move but rather based on the larger consensus. Thus, the opposition from the state governments is a bit surprising. Recently, the Honorable Finance Minister of Kerala has mentioned that his state does not intend to levy GST on essential items which small stores sell in 1 to 2 kg packets. Any such exceptions would only distort the overall framework of the GST and will make it even more complex, adding to disputes and litigation. The Congress party has asked for a revamp of the GST since it is fundamentally flawed and a bit of tinkering cannot resolve the issue. Many of the states have been expressing their concerns for some time, most recently in the just concluded GST Council meeting. To conclude, it is to the credit of the GST Council that the centre and the states held each other's hand to not just face the crisis but to lift our economy onto the path of recovery. It is this working together that has made India stand out now as the fastest growing economy this year and the further years. Tax rate rationalization is something which would happen sooner or later. Current inflationary concerns may have derailed the plans to tweak rates and the GST slabs, but it would eventually be a reality as both the centre and the states need revenues And lesser slabs would mean a simplified tax regime. Emboldened by the experience of half a decade, the remaining gaps between the expectation and the progress so far can be addressed to further simplify the tax structure, enhance the ease of doing business, increase compliance, and result in an overall reduction in tax rates and prices and augment revenue. Further, we should not forget that till a majority of the society comes under the tax net and complies with the law in both letter and spirit, widening the tax net will only continue to pose a challenge for the government. This is evident from our country's abysmally low tax to GDP ratio. Unless this happens, it is also challenging to lower the tax rates on the direct tax and GST front and further simplify the GST slab structure. In a nation as large as India with multiple stakeholders, it's not an easy task to have a simplified fiscal legislation. Therefore, it's going to be a long and slow journey with regular tussle, but probably that's how a large and vibrant democracy functions. It is still a long way to go for the GST administration to achieve the full potential of GST and make it a true, good and simple tax. With this, we have come to the end of our discussion on GST today. Please do let me know if you would like to know more about current affairs topics in the comment section. If you like the content, please do like, share and subscribe to my channel. All the best. Jai Hind.